8 million ounces moved in 7 days. Between January 1st and today, Comex silver delivery notices crossed levels the exchange hasn't confronted in over 4 decades. That number matters because it represents something the exchange hasn't confronted in over 4 decades. The last time delivery demand approached these levels at this velocity, two brothers from Texas had accumulated 1/3 of the world's tradable silver supply, and the Federal Reserve intervened to collapse the market in a single day. And what's happening now is different. There's no single buyer, no visible corner, no regulatory target, and that makes the current stress exponentially more dangerous. The Comex reported 1,124 January contracts, standing for delivery on January 7th. That is 8.1 million ounces moving through warehouse warrants in an off-month period when delivery activity should be dormant. January isn't March or May or September. Those are designated delivery months where institutional players roll positions and warehouses expect elevated activity. January is when the system rests, when open interest should decline, when registered inventory should stabilize. Instead, open interest increased by 1,400 contracts that same day. February, contracts jumped another 1,500. The system is accelerating into delivery demand, not away from it. And the explanation being offered by exchange operators and bullion banks does not reconcile with the mechanics of what's actually unfolding on the warehouse floor. The public-facing narrative will tell you this is arbitrage, that the spread between spot and futures widened enough to make London to New York metal flows profitable, that sophisticated traders are simply moving inventory to capture basis differentials, that registered stocks declined because eligible metal converted for delivery purposes before flowing back into the system. That's the benign interpretation. And it's incomplete. I'm going to show you why the current delivery surge represents something fundamentally different from normal market operations. I'll walk you through the mechanics of how exchange delivery actually functions, what constraints exist within that system, and where those constraints are beginning to fracture. By the end, you'll understand why the price you see quoted for silver increasingly diverges from the price you'd pay to secure actual metal, and why that divergence can't persist indefinitely without triggering either a market structure failure or a regulatory intervention that fundamentally alters how precious metals trade. I monitor metal flow data because institutional positioning in futures markets only tells you what traders believe will happen. Warehouse receipts tell you what's actually happening. Open interest shows speculation. Delivery notices show conviction. And when delivery notices in off months start exceeding peak month historical averages, that's not arbitrage noise. That's a signal that someone somewhere stopped believing the paper contract represents the same thing as the physical metal. Here's a term that matters: registered versus eligible inventory. Comex warehouses hold 2 categories of silver. Eligible inventory is metal stored in approved facilities that meets exchange specifications but is not currently available for delivery against futures contracts. Think of it as metal sitting in the warehouse that belongs to someone, but that someone isn't offering it for sale through the futures system. Registered inventory is metal specifically designated as available to satisfy contract delivery obligations. It's what backs the entire futures market. That distinction seems technical until you realize that conversion between eligible and registered status is voluntary. The warehouse operator can't force metal out of eligible status without owner consent. And when registered inventory declines, it means metal is either leaving the system entirely or owners are choosing to reclassify it as not for delivery. Since September, registered silver inventory at Comex has dropped by over 40 million ounces. That's not a normal seasonal drawdown. That's nearly 1/3 of the total registered base vanishing in 4 months, while delivery demand simultaneously accelerates. The exchange currently holds approximately 127 million ounces in registered status. Against that inventory, there are futures contracts representing multiples of that amount in potential delivery obligations. Now here's the mechanism most people miss. When a futures contract enters its delivery period, the holder can either close the position for cash settlement, roll it forward to the next contract month, or stand for delivery. The assumption underlying the entire futures market structure is that the overwhelming majority will settle in cash. 98% historically, maybe 99% during calm periods. The system works because almost everyone trades the contract as a price exposure vehicle, not as a mechanism for acquiring physical metal. When that ratio shifts, when 3% or 5% or 10% decide they want actual silver rather than a cash equivalent, the math changes completely. And it changes in a non-linear way that most market participants don't internalize until it is too late. The official story says elevated deliveries in December, March, and May were driven by arbitrage opportunities. The spot to futures spread widened. Traders brought metal from London, where prices quoted lower, delivered it into Comex warehouses, collected the delivery premium, then withdrew and repeated. Normal market-making activity responding to price dislocations. That's not what actually happened. The Comex instituted operational changes beginning in December that restricted certain types of leverage positions in precious metals futures. Not publicized restrictions, not emergency measures framed as market protection. Quiet operational adjustments to margin requirements and position concentration limits that altered the risk-reward calculation for major desk participants. Those changes coincided exactly with the surge in delivery demand. When you restrict leverage, you force position reduction. When forced sellers meet a market where natural buyers prefer physical settlement over cash, prices should decline until a new clearing level establishes. That didn't happen. Prices remained elevated while delivery notices climbed, which means either the selling pressure never materialized or the physical demand absorption overwhelmed it entirely. Let me walk you through how this system normally functions, because each layer reveals a dependency that matters when stress appears. Layer 1 is the futures exchange itself. Comex operates as a clearinghouse where buyers and sellers post margin, contracts trade at standardized specifications, and settlement occurs either in cash or through warehouse warrant transfer. The exchange assumes both sides of every transaction, guaranteeing performance. That guarantee requires the exchange maintain clearing fund reserves sufficient to cover default risk from its largest participants. Layer 2 is the network of approved warehouses. These facilities store metal on behalf of owners and issue warehouse receipts that serve as delivery instruments. When a futures seller delivers against a contract, they transfer a warehouse warrant to the buyer. No physical metal moves. The receipt changes hands. The buyer now owns a claim against metal sitting in a specific vault. Layer 3 is the authorized participant structure. These are the bullion banks and market makers approved to issue and redeem warehouse receipts, facilitate delivery logistics, and provide liquidity to the physical market. Their business model relies on capturing bid-ask spreads while maintaining minimal actual metal inventory. They operate on margin compression, high velocity, low absolute exposure. Layer 4 is the assumption that paper and physical remain functionally interchangeable, that someone holding a futures contract or a warehouse warrant could, if they chose, convert that paper claim into actual metal bars sitting on a pallet in a Brinks or Delaware depository facility. This assumption allows the entire financial structure to exist. Without it, futures contracts become pure speculation disconnected from underlying commodity value. And layer 5, the critical foundation, the confidence that the system will always prioritize institutional continuity over individual claim enforcement, that if stress appears, exchanges will modify rules, extend settlement timelines, or simply declare cash equivalent satisfaction of delivery obligations, rather than force physical metal transfers that could expose inventory shortfalls. Stay with me, because this is where it changes. The core assumption everything relies on is that industrial users, jewelry manufacturers, and technology companies need predictable silver pricing, but don't want to manage physical inventory. They hedge through futures. They lock in costs. They settle in cash and buy their actual metal through separate supply chains that handle logistics, refining, and transportation. This assumption worked for decades because the industrial demand base remained stable and the financial speculation stayed primarily cash settled. Even during the 2008 financial crisis and the European sovereign debt period, delivery demand increased but remained within system capacity. Registered inventory fluctuated but never approached depletion. The assumption held. It can't hold anymore because the composition of buyers has changed. These aren't industrial hedgers rolling positions quarter to quarter. The delivery notices show a different pattern. Multiple small to medium-sized accounts standing for delivery in off months. Repeated delivery actions from the same entities. Immediate withdrawal of metal from warehouse inventory after warrant transfer. That pattern indicates buyers who view Comex as a sourcing mechanism, not a hedging venue. They're using the futures market to acquire physical metal because direct purchases from refiners or dealers carry wider premiums over spot. They discovered that standing for delivery, paying the futures price plus logistics, results in lower all-in costs than buying through normal physical channels. This creates a calculation problem for the exchange and the authorized participants who intermediate delivery. Let's work through the stress scenario in real numbers. Baseline assumption. Comex Silver open interest runs at approximately 120,000 contracts. Each contract represents 5,000 ounces. That's 600 million ounces of notional exposure. Against that, registered inventory of 127 million ounces. The ratio is 4.7 to 1, meaning paper claims exceed deliverable metal by a factor approaching 5. Under normal operations, if 2% stand for delivery, that's 2,400 contracts or 12 million ounces, manageable. Registered inventory covers the demand, metal converts from eligible as needed, system equilibrium maintains. New condition, delivery demand increases to 5%. Now you're looking at 6,000 contracts, 30 million ounces. That's 23% of total registered inventory in a single month. And if that demand persists across multiple delivery months, if March sees similar intensity followed by May, You're extracting 80 to 90 million ounces across the quarter. At that drawdown rate, registered inventory depletes entirely by summer. The exchange would face three options: force eligible metal into registered status against owner consent, implement cash settlement rules declaring delivery satisfaction through equivalent value payment instead of metal transfer, or allow the market to discover what the actual clearing price is when available supply can't meet delivery demand at current futures prices. None of those options are viable without breaking something fundamental in how the market operates. The first violates property rights and would trigger immediate legal challenges, plus mass metal withdrawal from the warehouse system. The second destroys the entire premise that futures contracts represent genuine commodity exposure, turning them into pure financial instruments with no underlying linkage. The third means price discovery happens through a squeeze dynamic where anyone holding a contract that must deliver faces unlimited upside risk. This is where the math breaks. If registered inventory depletes towards zero and the exchange implements forced cash settlement, the contract trades at one price while actual metal trades at another. That spread can widen to 20, 30, 50% before it stabilizes. And during that dislocation period, anyone holding short exposure to physical silver faces mark-to-market losses that are not reflected in the futures price they're using for hedge accounting. Here's the critical point. The institutional structure that facilitates precious metals trading operates on assumptions about participant behavior. When behavior changes, when market users stop accepting cash as equivalent to metal, confidence in the system's ability to perform its core function evaporates. And confidence collapse in leveraged markets follows a specific pattern. Think about what happens when a crowded bar announces last call. Normal behavior is orderly. People finish drinks, they settle tabs, they exit through marked doors at reasonable pace. Now announce there's smoke. Don't even say fire, just smoke. The crowd doesn't speed up incrementally. There's a threshold where individual rational behavior shifts to collective panic, and exit capacity becomes the binding constraint. That's what nonlinear failure looks like in liquidity events. The market appears stable. Bid-ask spreads remain tight. Open interest continues functioning. Then one participant larger than expected stands for delivery, can't be satisfied at quoted price. Defaults or demands, emergency accommodation. And suddenly every other market participant recalculates their exposure to the same unwind risk. In silver specifically, this manifests as the spot futures spread, normally under 20 cents. Since December, it's blown out to levels exceeding $2 in sustained periods. That spread represents the disconnect between what paper contracts trade for and what it costs to source actual metal. When that spread persists, when it doesn't compress through normal arbitrage mechanics, it signals that the arbitrage itself carries risk participants don't want to assume. The risk is delivery failure, that you sell a futures contract, collect the premium, but can't acquire metal to deliver when the contract expires. Or that you buy a futures contract, stand for delivery, but the counterparty defaults and you receive cash settlement at an exchange-determined price rather than metal at your contracted price. Once that risk becomes priced into the spread, once participants demand compensation for bearing it, you're no longer operating in a normal commodity market. You're operating in a stressed market where paper and physical are actively diverging. We're watching two realities develop simultaneously. In one reality, silver futures trade at $85 per ounce, open interest remains stable, exchange reports show normal operations continuing, clearinghouse guarantees function, margin requirements get met, delivery logistics proceed without headline disruptions. In the other reality, if you want to buy 5,000 ounces of silver bars for delivery to a vault you control, you're paying $92 to $95 per ounce after premiums, logistics, and timing delays. You're calling 4 different dealers. 2 can't source metal within 30 days. 1 offers a price but won't commit until spot settles. The 4th will commit but requires payment up front with delivery in 6 weeks. That spread between what the futures market says silver costs and what it actually costs to acquire metal represents a form of price discovery that hasn't fully occurred yet. The futures price reflects financial participants' trading contracts. The physical price reflects actual supply-demand clearing where metal changes hands. Those two prices must converge. Either futures rise to meet physical, which means the paper market reprices to acknowledge scarcity, or physical falls to meet futures, which means supply increases enough to satisfy elevated delivery demand. Or the system fractures, and they continue diverging until regulatory intervention forces a new structure. There are 3 possible outcomes here, and I want to be clear about the probability distribution, because managing this kind of risk requires honest assessment, not hopeful thinking. Outcome 1 is the fantasy scenario. Supply increases dramatically. New mine production accelerates, recycling ramps up, and industrial users curtail discretionary consumption. Registered inventory rebuilds. Delivery demand normalizes. Futures and physical prices realign. Spreads compress. Market returns to historical operating parameters. This outcome has maybe a 5% probability. Mine production operates on multi-year development timelines. Recycling responds to price but can't scale fast enough to matter on quarterly timelines. Industrial curtailment would require silver prices to exceed substitution thresholds, which sit considerably higher than current levels for most applications. Electronics manufacturing doesn't work without silver. Solar panel production doesn't pause to wait for better silver prices. Outcome 2 is the corrupt outcome. Exchange operators implement cash settlement requirements, declaring delivery satisfaction through equivalent value transfers. Contract holders who stood for delivery receive a payment based on future settlement price rather than metal transfer. The legal justification claims emergency conditions necessitated modifications to preserve market stability. Litigation follows. Regulatory investigations launch. But metal never changes hands. This outcome carries maybe 25% probability. It preserves exchange solvency and authorized participant continuity. It prevents a default cascade that could destabilize broader commodity clearing systems. It protects institutional relationships that matter for ongoing market operations. The political and legal costs are manageable if framed correctly, but it also destroys trust permanently. Anyone holding silver exposure through futures or warehouse receipts would understand clearly that their claim is contingent on exchange discretion, not contractual enforcement. That realization triggers capital flight out of paper markets into physical possession, which then accelerates the very dynamics that forced cash settlement in the first place. Outcome 3 is the managed decline. Exchange operators allow delivery to continue, but implement position limits, increase margin requirements, restrict new contract issuance, and gradually reduce open interest. Metal flows out of registered inventory at controlled rates. Futures prices rise enough to discourage speculative standing for delivery, while remaining below the threshold that triggers industrial disruption. Physical premiums compress slowly as participants adjust to new clearing levels. This outcome has roughly 70% probability, because it represents the path of least systemic resistance. It acknowledges reality without forcing crisis. It allows price discovery without triggering panic. It maintains the fiction that futures and physical remain connected, while accepting that they all trade at persistent premiums to each other. The cost is that silver increasingly becomes unavailable at quoted futures prices. The market bifurcates into financial participants trading contracts and physical participants acquiring metal, with limited crossover between the two. That bifurcation already exists in gold to some degree. It would simply become explicit and permanent in silver. What this means for you is not that you should panic. Panic is what happens when you don't understand the system mechanics and react emotionally to price volatility. What you should do is recognize that precious metals markets are transitioning from one operational structure to another and position accordingly. If you hold silver exposure through futures or ETFs, understand that your claim may settle in cash rather than metal during stress periods. If that outcome is unacceptable, physical possession becomes the only mechanism that guarantees you actually own what you think you own. If you're considering entering a position, understand that premiums over spot for physical metal now reflect a structural component, not just dealer markup. Those premiums compensate for delivery risk, sourcing uncertainty, and time delays in acquisition. They're not temporary noise. They're information about actual clearing prices. If you're already holding physical metal, understand that the spread between your acquisition cost and current futures quotes doesn't represent your liquidation value. Your metal is worth what you can sell it for in the physical market, which consistently runs above futures prices. That premium is your compensation for having solved the delivery problem in advance. Do not attempt to time this. Do not try to trade in and out based on short-term price movements. The transition from paper to physical dominance happens in jumps, not smooth progressions. It happens when enough participants simultaneously lose confidence in paper settlement, and you won't get warning before that threshold hits. There are specific indicators to watch that will tell you whether stress is escalating or stabilizing. Check these weekly, not obsessively. First, registered inventory levels at Comex. The data publishes daily through CME Group's website. If registered silver drops below 100 million ounces, the system is approaching critical stress. Below 80 million, it's in crisis territory. If it rebounds above 150 million, then that signal supply is responding and pressure is easing. Second, the spot futures spread. When this exceeds $1 persistently, it means arbitrage risk is elevated. When it exceeds $2, it means arbitrage has effectively broken. When it compresses below 50 cents, it means normal market operations have resumed. Third, delivery notices in off months. January, February, April, June, August, October, November are all non-delivery months. If any of these months show delivery activity exceeding 3,000 contracts, it indicates continued high physical demand. If off-month delivery drops below 1,000 contracts, it suggests demand normalization. Fourth, warehouse metal, inflows and outflows. The CME reports daily movements. If you see persistent net outflows exceeding 10 million ounces per month, it means metal is leaving the system faster than it's arriving. If inflows exceed outflows for sustained periods, supply is catching up. Fifth, premiums on retail physical metal. Check dealer prices for American Silver Eagles or 1-ounce bars relative to spot. If premiums exceed $6 per ounce, physical markets are extremely tight. If premiums compress below $3, supply and demand are rebalancing. These indicators won't predict specific price movements. They'll tell you whether the structural stress in the delivery system is intensifying or resolving. That distinction matters more than short-term price direction because structural failure creates discontinuous moves that can't be hedged using normal volatility assumptions. Now zoom out to the broader context this sits within, because what's happening in silver isn't isolated. It is part of a larger transition in how commodity markets function. When financial claims exceed physical reality by ratios that approach absurd, we've operated for 40 years under a system where leverage, rehypothecation, and fractional reserve practices migrated from banking into commodity markets, where one bar of gold or silver could back multiple ownership claims because the assumption held that those claims would never simultaneously seek conversion to physical possession. That assumption worked during the era of dollar dominance, central bank credibility, and general confidence that financial claims represented adequate substitutes for tangible assets. It's breaking now because monetary policy, sovereign debt levels, and geopolitical fragmentation are all moving in directions that undermine confidence in paper claims. This isn't just silver, it's copper, with industrial users bypassing exchanges to lock in direct mine supply agreements. It's wheat and corn with processors building unprecedented stockpiles despite higher carry costs. It's crude oil with strategic petroleum reserve depletion revealing that buffer inventories were actually available when needed. The common thread is that when you operate markets at leverage ratios that assume coordinated restraint, confidence perpetuates the system. But confidence is conditional. It depends on participants believing that other participants will maintain the same behavioral patterns indefinitely. And once a few defect, once a few decide to demand physical settlement instead of accepting cash equivalents, the coordination unravels quickly. Silver is canary in coal mine sized. The total global silver market is around $1.4 trillion in annual flows. That's tiny compared to treasuries or equities or even gold, which means it hits critical mass faster. What you're watching in Comex delivery data is what happens when a small market with high leverage and limited buffer inventory faces a transition from paper claims to physical demand. The same mechanics will eventually apply to larger markets if the underlying drivers persist. If we're entering a period where hard assets matter more than financial claims on hard assets, every levered commodity market faces a version of this reckoning. Some will manage it smoothly, others will fracture. Silver is fracturing because the ratio of paper to physical was highest, the inventory buffers were thinnest, and the industrial demand was least elastic. But the principles at work aren't silver-specific. They're universal to any market where synthetic exposure exceeded genuine supply capacity. The question is not if this resolves. Markets always clear. Price is the variable that adjusts until supply and demand equalize, and if price can't adjust due to structural constraints, then quantity adjusts through rationing, delivery failure, or forced settlement modifications. The question is how long the transition takes and how much dislocation occurs during the adjustment period. 3 months, 6 months, 18 months. The time frame matters for position management, but doesn't change the fundamental direction. The system that allowed paper silver to trade as equivalent to physical silver is ending. What replaces it will either be a bifurcated market where futures become pure financial instruments detached from metal prices, or a restructured market where delivery capacity matches open interest at higher equilibrium prices. Either way, understanding that transition is occurring gives you the framework to make informed decisions rather than reacting to headlines after the shifts have already happened. The Hunt brothers parallel everyone references isn't actually parallel. In 1980, concentration mattered. 2 individuals controlling a third of tradable supply meant regulatory intervention could target specific actors. Margin changes forced liquidation. Position limits broke the corner. The silver spike collapsed because the buying power concentrated in entities subject to jurisdiction and leverage. What's happening now is diffuse. It's thousands of smaller participants independently reaching similar conclusions about paper versus physical equivalents. There's no single pressure point to regulate, no concentrated exposure to force unwind. The demand pattern is distributed, persistent, and driven by structural factors rather than speculative positioning. That makes current conditions more dangerous, not less, because the resolution mechanisms that worked in 1980 don't apply. You can't change margin rules to force liquidation when the buyers aren't leveraged. You can't implement position limits when the exposure is spread across multiple small accounts. You can't target a corner that doesn't exist. The only mechanism available is price, Let it rise until demand destruction occurs, until industrial users substitute away, until mine production responds, until the system finds a new clearing level where supply meets demand. But that price discovery hasn't happened. Yet because the futures market is still absorbing delivery demand without futures prices, fully adjusting to reflect physical scarcity. The longer that lag persists, the more violent the eventual convergence becomes when it arrives. And it will arrive. Markets don't maintain divergent pricing regimes indefinitely. They tolerate them for transitional periods, then they snap to new equilibrium suddenly, usually triggered by something seemingly unrelated that happens to be the catalyst that breaks residual confidence. So position for that reality. Understand you're navigating a market structure transition, not trading normal volatility. Understand that the rules governing how precious metals trade are being rewritten in real time through delivery behavior, not through regulatory announcements. And understand that the early signals are already visible if you know where to look. This isn't conspiracy. This isn't manipulation. This is how markets behave when assumptions break and new equilibrium hasn't yet established. The question isn't whether it resolves. The question is whether you're positioned for the resolution when it comes,